I think with so much quantitative easing, with subsidized interest rates, with central banks doing all kinds of things, building their balance sheets, et cetera, I think the curve there's too many other factors implicating it at the moment to fully sort of rely on it in the way that you used to be able to rely on it. So I do think it's still important. I don't want to discount it, but I don't think that, it's a de facto recession because the curve flattens or inverts. And so it bears watching, no question, in conjunction with other factors. I do think it's been diluted.
Michael Farr, I think of you as a bit of an old school guy on these kinds of things. Do you agree with Michael Cuggino or take exception?
Well, Michael Cuggino is a very smart guy, so you have to be very careful if you're going to disagree. But, I'm always scared when anybody says it's going to be different this time. Certainly it's a different environment. And yes, we've had all of the quantitative easing. But I think the important part is that the Fed has changed direction in interest rates. That's the whole story, I think, that you have to pay attention to, underlying all fundamentals. Rates are moving higher. They moved lower for a lot of years. So when that yield curve inverts, I think the risk is really very real. It's never been fun during my career in this business when we ever had an inverted yield curve. So I take some great concern when I see that happen. We haven't had a recession for a long time either, Skylar. We're kind of due for one. We're lined up for those pieces to fall in place.
Yeah, if you just think about reversal to the mean, statistically, you start to wonder. Mike Santoli, Michael Farr highlighted that the U.S. Federal Reserve is not going to have their foot on the pedal. They're going reverse. Also this week, we got hints that the Bank of Japan was actually going to do the same thing. I mean, barely, and yet it's cited as one of the reasons why our U.S. 10-year yield is climbing above 3%. So central bank policy around the world really is affecting things here, isn't it?
Oh, without a doubt. I mean, I think you can characterize the shift as kind of almost seismic. I mean, it really is that kind of a long-term turn in policy. But yes, Michelle, I mean, look, the Japanese 10-year yield released from below zero to something like 0.12% at one point. And yes, it did seem to have an outsized effect on our longer-term debt, which is interesting in a sense, because I do think maybe in general this whole conversation is a little premature about inverting the Treasury curve. Let's see, we have pretty much a slam dunk that in September the Fed's going to go up 25 basis points. Let's see how the longer end of the curve does behave at that point. And even once you get to dead flat, you still have lead time before it necessarily means recession. A lot of other factors have to fall into place.
Do I understand correctly why it is that if Japanese yields start to rise, ours would too? They've been so close to zero in Japan for so long that maybe a Japanese investor who used to look overseas for a higher yield sees they can get a little bit more at home, and then therefore there's fewer buyers for U.S. Treasuries? Is it that simple?
I mean, I think strictly at the margin, that's one of the dynamics out there, or it's just traders anticipating that kind of activity right now. But yes, in general, I do think that that's what you might see happen as a sort of a chain reaction in the capital markets.
You know, Michael Cuggino, usually markets or stock investors like the idea of a little bit of inflation. They don't mind a little bit of rising interest rates because it suggests that the economy is doing pretty well. Is that what you see, and what do you forecast, therefore, for the rest of this year and into 2019?
Yeah, I think the biggest risk with interest rates is too fast, too quickly, and too high. If you have growth and it's sustainable, then gradually rising interest rates and gradually rising inflation would be byproducts of that growth. So I don't think it's anything to be scared of necessarily. I think the other thing to keep in mind on the curve and interest rates, I would agree with Michael Farr that it is always risky when you have inversion and the risks of recession go up, et cetera. It's a big indicator, no question, regardless of how you feel about the validity of the curve nowadays. But I would also say that one of the things holding down the long end, and this gets back to Mike Santoli's point, is that the differential between U.S. rates and the rest of the world's rates are substantial. So you do have a lot of investors buying U.S. debt because the yield differential is so great. If you have global interest rates rising, whether it's Japan or the rest of the world, then that would take the pressure off of U.S. rates and potentially allow the long end to grow in conjunction with growth. So that's why I think that the yield curve bears watching, but it's not a de facto indicator of recession right now.